I'm joined by Glenn Maguire, Chief Asia-Pacific Economist at Societe Generale in Hong Kong. Glenn, good morning. Thank you for joining us. Glenn, I mean, you've already said that central banks in Asia remain way behind the curve. So does that interest rate hike from India put them closer to being where they should be?
Look, I think the move of 50 basis points speaks volumes for just how far Asian central banks are behind the curve. We still have the situation where for 75% of Asia, real rates are negative. And as we move into a higher energy, higher soft commodity inflation dynamic, that's just not a prudent policy setting. I think with India, the dynamic that is at most at work and probably triggered the 50 basis point move is the slippage we're seeing in fiscal policy. The states are going on a massive spending binge before local elections later this year, and the automatic stabilisers are starting to be engaged with oil and food subsidies starting to drag on expenditures. So what we're seeing is monetary policy and fiscal policy are in divergent directions at this stage, and I think this was Sabaro's way of saying, get the fiscal house in order.
Will they get the fiscal house in order once the state elections are out the way? Will oil companies, be able to charge more in a couple of weeks?
Look, I think, obviously we're going to see an automatic hit to inflation coming from the removal of fuel excises. Again, that's another unhelpful dynamic. Fuel, food, these are high-frequency purchases, very, very visible to consumers, and it makes it all the more easier for inflation expectations to become unhinged in that environment. And I think that's clearly what we're seeing in India more than any other Asian economy. As for fiscal policy, the slippage is much greater than I think the consensus is expecting. We're looking for the fiscal deficit this year to be 5.5% of GDP, compared to the government's estimate of 4.6%. So, a 1% of GDP shift in fiscal policy, that's a significant easing.
Australia as well today, Glenn. I mean, choosing not to raise interest rates, and there are factors behind that, the Queensland floods, the big factor. The correct decision, and if so, how soon should it be raising rates?
Look, the RBA made the correct decision, but it probably would have been a little bit preemptive and proactive if it did raise rates, even though that's obviously the next move. The Reserve Bank has considerably changed their rhetoric on inflation. They now expect that it will be higher than originally forecast. They've changed their key assessment of the economy from monetary policy as appropriate to inflation and activity will be monitored in coming quarters. The Reserve Bank is therefore live for a rate hike at any meeting in coming months. We're looking at August simply because that's the RBA will have the new inflation figures for Q2 released late January. They look to be high. 1% on the quarter is our forecast. That will take year-over inflation to 3.8%. And an inflation targeting central bank just cannot tolerate a breach of the inflation target to that extent.
Is it the big risk, Glenn? I mean, you've talked up the risks of inflation and the need for more stricter rates or rate policy in these Asian central banks. Is this the big risk to the region in 2011?
Absolutely, and extending into 2012. What we normally see in Asia, and it was a classic example, was 2007, 2008, policy tends to stall at the finish line. That is, the tightening cycle tends to be cut off a little bit too soon. What you see with growth above trend then is classic late cycle inflation dynamics kick in. We've seen that in the 07-08 cycle, and I'm pretty sure we're going to see it in 11 and 12. Inflation will probably surprise with a resurgence as we move through the turn of the year.